Good morning, folks. Thank you for tuning in. Today, I wanted to talk about some of the things I'm doing as an investor during these unprecedented times. There's a lot of uncertainty in the markets, and uh, so I'm going to discuss what my strategies are, how I'm making money right now in the markets. And before we begin, if you can please take the time out to like this video, subscribe to the channel, and we're just going to get right into the topic. So in the previous video, we discussed the impact rising rates had on the economy as a whole. Since the Fed began to tighten, we experienced two consecutive quarters of negative GDP. We're starting to see unemployment rise from 3.4 to 3.7%. However, you have to remember, we're still at historically low levels in terms of unemployment. The stock market responded with declines this year. The S&P right now is down, I think, about 24% on the year, and the Dow, I think, is down around 20% on the year as well. And for me, I'm normally in the buy and hold camp in that crowd there, but unfortunately, a lot of my positions that I currently had were positions that were open during the asset bubble we experienced the last 2 years, and so as a result, I had to basically make some changes, right? First I actually first began selling back in December 2021 in order to purchase a rental property. Look, I didn't foresee the declines that we're seeing now in the markets. The only reason I actually sold back then, like I said, was to purchase a rental property. It was just a way I wanted to take advantage of the low rates in order to help me diversify my investments. However, by May, I did start to, believe some of the cracks that we were seeing would cause some structural damage to the economy. Now, these cracks manifested itself into like a $12,000 loss on some trades that I made over like the course of a week or so back in May 2022. So now in May 2022, this forced me to sell most of my positions so I can digest everything that was happening. And so at that point, my portfolio was about 70% cash, right? The remaining stock, uh, at that point, my portfolio, like I said, was 70% stock. I did sell the remaining positions that I had last month. And now I hold basically four option contracts. There's like three long calls and one long put that I have. You know, the thing that was unfortunate about my sell earlier in May 2022, I don't feel like I had a very good plan when I sold most 70% of my position in May. Although I did purchase some inflation protected securities, treasury inflation protected securities, and also did purchase that rental property. Um, how it wasn't a result of what happened in May of me selling 70% of my positions in May. That's not the reason why I made those moves. I did want to take a break in order to digest everything that was happening to the markets and to the economy. Uh, However, I did not keep up with the data. At the time, I did not spend enough time reading in order to get other people's take on what was happening. And those things are really important. So I do normally spend a lot of time basically looking at the data, everything from I look at everything from GDP numbers, personal income. I look at unemployment rates. I look at all the as much statistics as I can to basically in order to kind of help to give me an idea what's the idea is to give me an idea of what's happening overall to the economy, right? And to see how bad things are, if it's continuing to get bad or if it's going to get better. It kind of helps you, like, helps me paint a better picture. And also, you want to read what other people have to say about it as well to make sure you're thinking about things the right way. Um, it honestly, it helps. The more, two heads are better than one. And so the more you can read other people's take, especially, I'm not saying just anyone on YouTube. You definitely want to look at, you want to basically read or listen to well-respected economists in these situations. Um, it's not just that they'll give you an idea what's happening, but a lot of times they'll help you formulate ideas. Sometimes their their approach, they end up revealing the approach to, like, to the analysis that they give, or the approach to how they arrived arrived at something. And so a lot of time learning what the approach is really helps you make better decisions, and also make better analysis in the future. Like I said, I did sell just about all of my positions last month. And so now I just wanted to talk about what I did with the cash once I sold it. That's pretty much what you guys are here for, right? And so the first thing that I did was I did purchase. I used 10% of my cash to purchase an ETF with the ticker symbol UUP, and this ETF tracks the dollar index. Although I was late to the party, I did purchase on like last month, but I'm still up. I think a little over 5%. I'm up since I purchased it, and I did this also because there's a lot of uncertainty in the markets, not just here in the U.S. but also overseas. And every time when there's a lot of uncertainty in the markets across the world, it seems like everyone wants U.S. dollars, and so and also, if you want to invest in something, I mean, like it's dollar denominated assets are probably the place you want to be, you know. And so essentially, if I think everyone wants U.S. dollars, and so that's just usually what happens every time there's a lot of volatility and there's uncertainty in the markets across the world. Everyone just wants dollars, and so as a result, since the dollar has been basically rising, has been strengthening, especially against like the euro, it just made a lot of sense for me to basically to just buy an ETF that's tracking, uh, you know, the dollar and that tracking that dollar index. Like I said, I already purchased some tips early in the year. However, I'm leaving bonds alone until the Fed signal that they're no longer going to raise rates, right? At that point, once I know they're not going to raise rates anymore, and we all know because they tend to signal what they're about to do, right? They're really good at signaling where the rates are heading, and so once they do that, then that's going to be my cue to begin buying either some treasury bonds or bond funds. And so I'm probably going to spend about 30% of my cash on the bond funds, and so that's pretty much what I'm going to do with 30% of the cash. And then the remaining money that I have in my account, I'm actually using it to purchase a second rental property. And so, and right now it's actually still in the process of closing, and hopefully everything goes smoothly. I like rental properties because it feels a bit safer than equities, especially at the moment. With rental properties, I think it's a little easier if you do your work and you do the homework. Um, it's a little more dependable, right? It's just with rental properties, you just have to make sure that you understand the rental market that you're going to be operating in, right? You want to make sure like you're conservative with your rental income. So once you know what that rental income is going to be that you're going to get every month, you want to look at the properties, right? The property that you want to buy. So with the property you want to buy, you just want to make sure you don't overpay, right? Number one. And the other thing, you just want to do your math. What are going to be your monthly expenses, right? And so as long as you have good financing and you don't overpay, and you do your math and you know what the monthly expenses are going to be, um, it's if your math works out and it shows that basically you're going to be able to make money owning that property, then it makes sense to do it. It makes sense to do it because the one thing is like the rental markets. I the prices have been going up pretty dramatically lately, and there is possibilities. I'm not going to say rental that like rental income never falls. I think that'll be a little crazy for me to say that because I'm sure uh, rent rental income does fall depending on what's going on. And so, but usually, as long as you're conservative, as long as you're conservative and you're operating in a good market, I think for the most part, I think it's going to be dependable, and you will always make pretty good money from rental properties. And also, like I said, financing is extremely important. There are different kinds of financing that are out that you have as options out there, especially when you're doing rental properties, because then it kind of pushes you from a regular mortgage from regular conventional mortgage to uh, commercial loans. And in my opinion, although the down payment is significantly higher, so there's not a lot of flexibility. There's a higher upfront cost with the commercial loans. However, in my the the your monthly expenses are going to be a lot more, are going to be much lower, and so that's why, right now I'm preferring to basically focus more in the rental market. And for the moment, I'm just going to have to stay away from equities for now, right? I am going to get back into equities at some point. However, I'm not getting back into equities until we get to the other side. And so, what I mean by the other side is just like with the bonds that I'm going to purchase, I have to wait until the number one. You have to wait until the Feds signal that they're no longer going to raise rates anymore, right? And so once they're no longer going to raise rates, now you need to wonder, okay, what's happening to the economy, right? Is it a situation where do they need to now reverse and start to lower rates? Are they going to have to lower rates because basically the economy is in a tailspin? And so if the economy is stagnating, or if it's well, actually, stagnating is not so bad. If it's just kind of like stagnating, we're not seeing any increase in productivity or increase in GDP from one quarter to the next. That's not so bad. But if we continue to see fall in GDP and we continue to see rise in unemployment, and there's going to be pain in the economy, then they're going to have to start to lower rates, right, in order to kind of like get the economy restarted again, right? And so in that situation, you definitely don't want to be. Yeah, I don't. In my opinion, I don't want to be in equities at that point either, because that means there's gonna be further declines, right? Because we don't know at that point if the economy is in a tailspin, that means the company is not going to be making as much money. There's going to be lower revenue, lower profits over time. And so then I need to try to figure out where is that bottom for the economy? When is the economy going to hit rock bottom? So what usually happens, they're going to keep lowering rates, and they're going to keep lowering it until they feel that the economy is basically stabilized and it's starting to go the other way. Once they signal that they're no longer going to lower rates anymore, that it looks like their easy money policy is beginning to work. At that point, that's when I'm going to be looking to jump back into equities, right? But for the moment, I'm just going to have to stay out of it, out of the equities at the moment. I truly believe there may be two phases to the decline. I did touch a little bit on it when I was just describing why when I'm going to jump back into equities. But I think there may be two phases to the decline. The first phase is I think is mostly technical in nature, and so what I mean by that is stocks decline because current rates are used to discount future cash flows, right? And so because that discount factor has been growing, it's been growing since March of this year. And so if we look over here, so let's go to this chart, this little table over here. I got this from Forbes magazine, and so thank you Forbes, their website anyway. And so this table basically is looking at basically all the policy this year, the interest rate policy for the Feds for 2022. As you guys see here, they first began raising rates March 17, 2022. And so ever since then, they've been raising it up until a few days ago, which was September 21st, was the last time they raised 75 basis point. And so the whole idea I just wanted to show, what I wanted to show you guys is basically now, this is not the discount factor like, analysts use, or, people that value stock. This isn't what it is right here, but the Fed funds rate is highly correlated with the discount factors that they're using. I think it's the treasuries. I'm not sure. Is it 2-year treasuries that companies tend to use? And so these are highly correlated with the uh, with the with the rates that are being used as the discount factor, right? And so as these rates continue to go up, those treasury rates are going to go up as well. And so that basically is going to that's what you're using to discount the future cash flows, like I said. And so as those rates go up, the future, the value, the present value of those future cash flows are going to be a lot less. Is going to decrease, and so in turn, the value of the company is also going to decrease, right? And so, all this is also on top of the fact that high inflation is also eating away at company profits, and so. With the second phase of the decline, it may come if the tightening policy brings about too much unemployment, right? And so let's say if unemployment rises like above 7%, we may start to really see a lot of pain, like I was discussing, just a few minutes earlier. And so if that's the case, then definitely um, investors are not going to be easy to jump back into equity markets if there's a lot of pain, right? They're going to want to know basically they're going to want to be able to predict where the bottom is for the economy before they can get back into equities. And so if that happens, then we may see like a second phase of the decline that's going to be, that's really just more about the fact that the economy is in a tailspin and we don't know where the bottom might be. Now we just want to kind of let's keep in mind that slow it down a bit and just keep in mind that like we're a long way away from like let's say high unemployment or even 7% unemployment. Right now the unemployment is still at 3.7%. All those historically low rates, it is start beginning to rise, and it's just something they have to keep an eye on. Now, if the Feds are able to find a way to curb inflation without unemployment, let's say rising above 6%, then I think they might be able to execute that softish. That would mean they'll be able to possibly execute that softish landing that they were talking about. And if they're able to do that, we may not see that second phase of the decline. So it might be just a decline that's just mostly technical in nature, where just repricing is just happening because rates are rising, and then also because of the fact that like also inflation is also eating away at corporate profits. So yeah, and so that's pretty much what I think happens. We're gonna go back to this. We're gonna look at some of this chart again. Right now, I wanted to talk more about the chart that we have up here. So we have this one here on the left is the Fed's balance sheet, and if you see here, the Federal Reserve began to reduce the balance sheet around the same time they started raising rates, right? So they've been doing it in tandem. However, if you look here, a lot of, we started to see, deterioration in equity values, like I want to say end of 2021, right? And the beginning of 2022, it's almost felt like I think it was like sort of like a double top where there was like a high in November or December 2021, and then we reached another high in like first day of 2022. But then ever since then, it's been like just drastically declining. And I think the reason why that is like when that declined, we started seeing that decline in November or December 2021, and in the equities market, not just equities market. If you guys remember, the same thing with the home values that I was looking at, the home values that I looked at in the previous video. If you guys notice the deterioration in home values, at least the growth of prices, home prices basically started to really sharply decline like in November or December 2021. And I believe the reason why that is because the they always signal what they're going to do with the interest rates. And so a lot of like we already started seeing like really high inflation rates like late 2021. By November, December 2021, they were already signaling that basically they will begin raising rates um, in early 2022. And I think that's the reason why we started to see deterioration in equity values and also in the growth rate of home prices. And so that was really interesting, right? It's like um, when they started to signal that I can see equities, deterioration in equity values, right? But with the home prices, to see the growth rate just kind of tank and drop off, that was really interesting because if you think about it, normal Americans are not really paying attention to Fed policy that way. And so there's no reason why, the Feds or someone could signaling that rates are going to go up, then Americans are going to say like, oh, you know what? I don't want to buy, I don't think I'm really that eager to purchase these homes anymore because Feds might raise rates like, come March 2022. And so that's going to be another video we're going to do why that happened. And I think a lot of it has to do, obviously, with why, regular Americans can no longer afford homes. And of course, that's because of, the fact that investors, not just large hedge funds, and also small investors have been basically participating in the real estate market a lot more these days. I mean, look at someone like me. It's like I'm normally uh, primarily my income is from my 9 to 5, and then I have some investments, uh, which is basically basically combination of some bonds, stocks, and some mutual funds, and that's pretty much what I've mostly done my whole life. And I think a lot of Americans, that's kind of like what it normally is. But now you're getting more and more investors, smaller investors investing in rental properties, but the biggest problem is the huge institutions like these hedge funds like BlackRock basically buying up basically swaths of land in the United States. And I think that's why we're able to see that in that chart where like as soon as basically there was speculation that Feds were going to be raising rates, the prices started to cool down like right away. It doesn't make any sense, right? That's not regular Americans like paying attention to the Fed. Like, oh, you guys are going to raise rates, then I better not purchase any more, home. I better not purchase a home for my family or like, So that's pretty much what I wanted to say about that. That was pretty interesting. But yeah, so we started to see these declines as a result of the Feds, because it's really interesting. So the declines in these in the equity markets and also in the high in housing values were because the Feds really started to signal that they were going to raise rates. So that's really interesting to see that they don't even investors are not obviously they're not going to wait for the Feds to take action. They're going to preemptively uh, sell their investments, obviously in anticipation that the Feds are going to raise rates. And so basically, this second chart here is just pretty simple. This is basically um, the ETF that I purchased, UUP, and so it's just an ETF that tracks the U.S. dollar index. And the reason why I did that, like I said, I already explained it. U.S. dollars are the world's reserve currency, and so usually when there's a lot of uncertainty in the market, especially world market, like the markets across the world, everyone wants dollars, and so it just made sense for me to basically use some of my money to just buy this ETF, and it's worked out really well. And so I'm really happy that I did it. And then the other thing too that I normally would do, I didn't do it this time around. I usually buy VIX. I'll usually buy an ETF that tracks VIX. And so that's what I normally do in these situations. Well, I normally don't buy right now when the market's already deteriorated, like what I normally did. And I did own some VIX actually earlier, for much of this year actually. When I first sold 70%, I did use some of the money to buy some VIX at the time, and so that was part of what was left that I ended up selling. And so usually, if you're buying an ETF that tracks volatility, for me, I don't buy it. I've always gotten in the habit of buying it when times are good, when the markets are doing really well. So I usually buy the an ETF that's tracking volatility at that point, because the at that point is going to be um, the price of that ETF tracking volatility is going to be really low, and so as the market goes to crap, the value of of that ETF tracking volatility is also going to increase. And so, but I didn't hold on to it. I ended up selling it. It was one of the ones I ended up selling in. That ended up selling in August. I just needed a little more. I just preferred to just go with the ETF that's tracking the dollar index, and so that's pretty much what this have here. As you guys can see, it's up about five. I'm not up 5.22%. I think I'm up like a little closer to 5%. So but it's really interesting, and so it's a good thing that I did purchase it, and so and so far it's been working out well for me. Let me know what you guys think. Please please like this video, subscribe to the channel, and feel free to email me if you have any questions.